Today, we are starting the show with a very special opening. Rob has found his religion over the weekend and is electing to lead us in a prayer. So, Rob, why don't you lead the way?
I would just like to say that we have to recognize who is most important in our lives, and that is Fannie Mae and Freddie Mac. Without them, we would be nowhere, and they are completely and utterly vital to our business. And so I think it's important that we wake up every single day and recognizing that that is the fact and that we need to do everything in our power to make them smile upon us and wish us the best, because they are a powerful but benevolent entity. They can destroy us in one fell swoop, or they can take us to the promised land. And where is the promised land? The promised land is Freddie Mac Borrower Channel. That's my goal in life. And for those that don't know what Borrower Channel is, it is akin to being a Fannie Mae select sponsor. I think maybe I'm getting them mixed up, but basically they have these sister categories: select sponsor, borrower channel. I think I had them mixed up. But anyway, basically, if you achieve select sponsor status, then you get preferential treatment from Fannie Mae or Freddie Mac, depending on who you focus on. We focus more on Freddie Mac. We've developed a more robust relationship with them. And I think that give it a couple years, we will be a select sponsor, which will allow us to get preferential treatment on waivers like extra IO, DSCR waivers, lower interest rate spreads, and LTV waivers if we want them. So there's a lot of benefit that comes with being a select sponsor with the agencies, and I can't wait for those days. So I get up every morning and I think, how do I make Fannie Mae and Freddie Mac happy? And the funny and ironic thing about that is what makes them unhappy actually is this podcast. This podcast, they don't watch this podcast, but they know that we have this podcast. They know that this podcast exists, and they view anyone with a podcast as evil. And they think that the syndicator sponsor, the podcast syndicator, those are the people that they watch out for and that they are more hesitant in doing business with. So we have a twice as difficult mission, because we need to actually show Fannie Mae and Freddie Mac that it is 2024. It's not 1974. It's 2024, and we're going to crush it in business with them, as well as with our investors and our partners that we attract through our podcast. So that's our goal in life: to be a select sponsor, to make Freddie Mac proud, to make our investors happy, and to grow our business.
Are you trying to make the agencies great again? Is this your call to that?
I'd say they're already pretty great, especially in times of distress. And I don't want to overplay what's going on today, but the reality is, in times of distress, there's a lack of liquidity. That's almost what defines a period of distress. And the beautiful thing
Or
about
cost of capital,
multifamily,
right?
well, liquidity is related to cost of capital, because you could say, oh, well, there's liquidity out there right now. Or in a time of distress, you could say, well, there's liquidity, but at what price, right? Exactly like you said, what cost of capital, right? There's going to be some opportunistic character that's willing to come in and do rescue capital, rescue pref, or whatever, but they're not rescuing you. They're just crushing you with a 25% interest rate. So meanwhile, Fannie Mae and Freddie Mac, they are government-sponsored enterprises with a mission just like ours to preserve and enhance and further affordable housing. So they're not there to take advantage. They're not there to screw people over. They're there to provide liquidity, particularly for affordable housing. So in times of distress, they're still there, pumping away, and they're actually quite busy right now because a lot of alternative lending sources are unavailable or unattractive. So people are even more so than normal focusing in on the agencies right now.
So where did this come from? Where did this rant from the clouds, where did this call to prayer and action kind of arise from? What are you experiencing right now? Are you talking your own book here? Enlighten us.
I was on the treadmill this morning and I was just thinking about, wow, I just
You're
can't
back in
wait.
the gym.
Yes, today was actually my second day being back. So I'm officially back. No more excuses, nothing. I'm back. So I'm back.
All right, so
And
you're on the treadmill.
And actually, yesterday on the treadmill is where I got my great idea, and I started working out because I had no idea what I was going to talk about for my presentation at our Lone Star Summit for my keynote. And then yesterday on the treadmill, I worked out what I'm going to talk about. Boom, so that happened. And then today on the treadmill, I just thought about, wow, it's game over once we become a select sponsor. Once we become a select sponsor, our operations are dialed in, our debt is dialed in, our investors are dialed in, we are unstoppable. So it just got me really excited about that, but then it kind of got me down because it reminded me about the fact that Fannie and Freddie don't take too kindly to the podcasting types.
Right. Well, what does one have to do to become a select sponsor? What are the benefits? I remember we spoke about this prior personally. I don't know if it was online, offline, but what are some of the benefits and the advantages one gets from the partnership and the status of said partnership?
Yeah, it's a moving target. It's not an explicit program like, hey, if you hit these clearly defined requirements, then you're going to automatically become a select sponsor. You have to be a good borrower in their eyes, and that can be a moving target. But the high level criteria is at a minimum, you need to be doing 200 million in loan volume with them per year. And that's not with Fannie or Freddie, it's one of them. So if you want to basically have select sponsor status with both, it would be 200 million with Fannie, 200 million with Freddie. That's very difficult to do. So we certainly could be around that 200 million mark. That's achievable for us. But it's more than that, right? It's just they're not just looking to do business and give preferential terms to whoever's the biggest and doing the most activity. It's also about being a good borrower, meaning you've never defaulted, you do what you say you're going to do, you hit your covenants, you're doing your capex plans and your draws and et cetera. So just if we do the right things, everything will fall into place.
When do we plan on hopefully being there, or is there a clear path to get there? Is there a certain number of dollar volume to hit in order to achieve that above and beyond what you just mentioned?
Well, I definitely don't think now's the time to do it. Right now, the agencies are spending a lot of their time thinking about and worrying about their existing portfolio. So rather than looking around at their relationships and figuring out, oh, who can we uplift and upgrade, they're actually looking at who can they downgrade right now? Who can they put on their blacklist because they're seeing what's going on right now, right? The tide's going out, so they're seeing who's naked. So right now is the time to not go in and ask for a favor. Right now is the time to actually show up and be a good partner and prove to them that we've got what it takes. But then on the back end of this, when the cycle recovers and things are more back to normal, if you will, or even more than back to normal, but actually kind of hot and bubbly again, like 2019, 2020, 21, that will be the time, I think, 2, 3 years from now to go for that.
So, do those benefits go to fixed rate debt only, or does it also help with floating rate debt with maybe rate caps? Or is that through basically every vehicle or debt vehicle product that the agencies allow and I guess lend on?
Yeah, it's pretty much throughout all the programs. Whether it's fixed or floating, you're going to get a spread reduction. So if your interest rate all in is 30 basis points less than market, that's a competitive advantage for you to be able to outcompete against other bidders in the market.
Well, especially, I think by the time that we're probably on this list, we might have gone full cycle on the portfolio we have currently, which begs the idea and the thought of this, which is when we go full cycle on these deals, as we were talking about last night, just on the phone call, I think before we both went to bed, trading into longer term deals, 10-year, maybe 10-year debt opportunities and really core strong areas of perhaps, Austin, Dallas, Houston, you name it, switching from the deals we're doing now into those opportunities with longer fixed rate debt, not really needing to squeeze out every and soak out every little piece of value. You do that with floating rate debt, which typically speaking is the preferred vehicle for borrowing. That becomes very interesting.
Did you mean floating or did you mean fixed?
Floating. Eventually, I think floating might be the play. If don't over lever, if you buy really good quality real estate, yeah, maybe a couple years you might go a little bit thin on cash flow, but the upside's pretty immense. Also, the flexibility is nice if you want to exit, if there's a clear path to do so. And also, if you buy a good rate cap, like, hey, you just basically simulate at the highest end this is what it looks like. And then, best case, we can simulate what that looks like as well.
Yeah, I think if you're looking at longer term ownership, I think fixing the rate makes more sense than floating, just because while you might be able to optimize returns with a floating rate loan, the variability of outcomes and the not being able to sleep well at night, right? It's almost even, there's like an emotional aspect to it, similar to one's desire to own their primary residence without debt, right? That's not necessarily a financial, yeah, that's not a financial decision. That's an emotional decision, right? Because if you were purely crunching the numbers, you would take a mortgage out on your house and then you would invest the difference at a higher rate of return than the cost of the mortgage, right? It's very straightforward. But rich people don't do that. They own their house cash. So this is similar. Like you'd say, okay, well, if we're trying to squeeze every drop of return out, what we would do is we would buy deals and then we would try to sell them as quickly as possible to monetize the appreciation. And you can't do that if you have a fixed rate loan, because the fixed rate loan is going to encumber the deal with very high prepayment penalties. Whereas a floater will give you the flexibility to exit and then maximize the return. So people who take a lower return approach, longer term approach, they're going to fix the rate because it helps them sleep well at night. They're not so worried about maximizing the return of the deal, so they don't need to be able to have the ability to take advantage of an opportunistic exit. So I don't know. I think obviously everyone can do what they want, but that's typically what you see.
Makes sense. Well, switching gears to some items, our long lost friend, James Ang, released a webinar. I took some really good notes I can share with everyone. But first takeaway, what were your kind of thoughts at a, kind of macro and general level, not with kind of the notes in front of you, but just as you watched it, what was your kind of reaction and thought and overall sentiment and takeaway following all of it?
Well, it's a repetition of what we've been saying, what a lot of other people have been saying for a long time. And I'll say this again, which is a meta analysis of what I just said, which is real estate's a slow moving animal. And so the trends that we're talking about and the things that we're giving this play by play, but it's not like we're giving the play by play of 100-mile-an-hour pitch, right? This is happening over quarters, months and months and quarters. And
You
so,
hear every week and every week, and then they're analyzing a once a month, I guess, piece of data on top of what they're seeing in their day to day, and they do it monthly, at a macro level versus this is a little more nitty gritty and granular.
yeah, so if we take the temperature on the market every week, it's kind of from week to week, there's no real perceptible change. But if you zoom out, the change is absolutely happening. And like in James Ang's monthly webinar, he was talking about supply. We have an oversupply issue in the short term. There's 500,000 to 600,000 units being delivered in 2024. There's going to be a bunch more delivered in 25. So basically, don't count on rent growth for the next year and a half. But
Mm-hmm.
the back end of 2025 and certainly 2026, there's actually going to be a dearth of supply. And that's the nature of a cycle, right? Things don't just move perfectly in a straight line. We kind of overbuild and then we underbuild, overbuild and underbuild, right? Rates go too high, rates go too low. Investor psychology, too greedy, too pessimistic. So it's just one of those cycles. And rent growth is going to come back with a vengeance in 2026. And so if you're looking at your model, like for example, we underwrite as just a standard practice a 3% rent growth per year coupled with 3% expense growth per year. Is that right? No, that's super wrong. Like how in the world could you reasonably actually predict that every single year rents and expenses are just going to go up by 3% perfectly, right? That's obviously not going to happen. That wouldn't be my best guess. But that's what we plug into the spreadsheet as a base case to model our analysis, because it's not really beneficial to us to break it down and think, okay, well, in the first year, it's going to be 1%. Then in the next year, it's going to be 2%. And then the next year, it's going to be 5%. And then it's going to cool down to 3%. No, that's not helpful, because then it makes it difficult to compare apples to apples when evaluating deals. But the reality is that 3% per year rent growth is probably going to work out to be roughly correct. Not precisely correct, but roughly correct, because maybe 2025 brings 0% rent growth, but then maybe 2026 is 8%, and then maybe 2027 is 5%, right? So that's my take on the supply issue and the near term versus the medium term.
Any other takes you have before I get to my notes, and I'll just kind of belt them out?
No, go ahead.
So, to your point, 2024, 500 to 600,000 units will be delivered, hurting the market. That's 2 times more than the normal amount over the last 7 to 8 years. So, as you alluded to, a oversaturation of units coming online naturally that makes it more of a renter's market. We knew that. Interest rates hurt commercial real estate values, but also make it harder to get into a house. And then the spread between home ownership and rental costs grew to 1144 in Q2 of 2024, driven by high rates. This is an all-time high spread. So all things that we've been talking about in this podcast, frankly, which I give us credit because we're right on the nose here. The data that we're analyzing, things we've been talking about, this is being reported. People are talking about this, but we were here first. And then rent growth has been about 1% plus or minus, dependent on the market. 1 year of rents being flat to absorb the supply coming online. So, or 1 more year of rent being kind of flat, essentially. Austin, though, -7% year over year rent growth. Eesh, not good. Multifamily debt originations lowest since 2015 in H1 of 2024. So that's kind of crazy. And that is new deals, not refinances or something like that. That's new deals, new dollars going out. So very little deal flow right now.
I think that's all originations,
Mm.
refis,
Oh,
and new
wow.
debt. I think that's all new debt originated.
Crazy. Cap rate expansion has peaked, but uncertainty will delay sales. Sale value recovery until 2025. I had a little typo there, but cap rate expansion. The cliff note there is cap rates have peaked. Camden, I believe they're an owner operator, correct?
Yes.
Yeah, so Camden, waiting game. Everyone in the multifamily is waiting for something. And then insurance pricing is cooling, not rising again this year, which is interesting. So insurance is kind of staying flat. I'd be curious to hear your perspective on that, but that's really good. One of the very consistent questions I was getting when I'm selling a lot of these deals, talking about these deals, is, hey, what are you doing for your insurance increases? Because that's been such a crazy number. So that is refreshing to hear. That's what they're seeing in their portfolio. Blackstone, you may have heard of them. In Q2 of 24, of course, deployed 34 billion, and then they are calling for a new cycle.
I love the cap rate expansion has peaked. I don't know from where they took that or something, but I know they were. I know, and James was also posting the CBRE cap rate survey that I think is always interesting to look at. But it's so funny how not that long ago we were talking to people who are supposedly smart, institutional money, the big wigs in New York, and they're saying, "Oh yeah, if you don't have a 6.5 exit cap on that deal, it's not for us. It doesn't make sense." And it just only a few months later that looks so silly. And they're the ones that think they're smart when they say that because yeah, we're being conservative and I'm looking to buy a 7 cap. It's like, well, sorry, that's not going to happen here. There's too
Where?
much liquidity. Yeah, where? The liquidity is back. I'm not saying that it's all up from here.
Tulsa?
So yeah, it's just funny how psychology sways so much more than the actual fundamentals do. And this is very similar. And this is not just real estate private equity firms. This goes all the way to the top, to the Fed, right? Jay Powell just a month or so ago was talking about how yes, we have a very resilient labor market, and we're worried about the labor market overheating, and we're worried about inflation. Guess what? Now there's no talk about labor market overheating, about inflation concerns. It's all risk to the downside. We're worried about disinflation. We're worried about losing too many jobs. The revisions to the job data is unbelievable. So it's just interesting how things quickly flip. And Jay Powell's now opened the door to a 50 basis point rate cut in September. I don't think that's necessarily the base case at this time. We'll see as the data comes out
Pretty
here in
steep.
the coming days. But I mean, I would say it's a 20-ish% chance of a 50 basis point cut. So again, just as I said, funny how things change.
For sure. And I just think it goes back to just because someone has a interesting position or great title does not necessarily mean that their predictions are more accurate or smarter than what you're doing on your day to day. Have conviction, have confidence, buy in all parts of the cycle, I think is kind of what I'm hearing from you. And I think we're going to be looking around at some of these acquisitions we've done all throughout this year and the next as, oh my gosh, so happy we bought. And even the deals last year that we bought, I think we'll be grateful for. I think rent growth, unfortunately, for the first 2 years of that vintage of acquisition are going to be a little lackluster. I think it's safe to say, but will pricing be higher in, call it, 4 years from today when we'll be looking to exit those properties? Likely, yes. And funny enough, we'll probably be selling everything we currently own in about 4 years, I would say. So 2028 will be a very active year for Lone Star Capital of deploying from deals. Okay, let's get into a question that we had on YouTube, which you answered very nicely, but I'll just ask it to you here. Sorry, let me zoom in my fonts. Why do you guys only focus on multifamily housing over multifamily development? If you do, why do you prefer acquisitions over development?
Well, there's no right answer. Everyone has their own way of making money and their own strategy. Frankly, acquisitions has a lower barrier to entry than development, so it's easier to get started. So that's how we got started, like most people. And development has a very different risk profile. It's kind of a different personality type for development as well. You're kind of laying the groundwork. It's a big, long runway with a lot of delayed gratification and then a lot of upfront risk that the developer is personally taking. We think we take a lot of risk, and we do take a lot of risk, and we put a property under contract and we put non-refundable money up with the seller and stuff like that. And those are big risks, and we've been burned. But developer, yeah, unless you have really deep pockets or investors who are willing to take pre-development risk with you, you're talking about buying unentitled land, and then you're taking entitlement risk with your personal capital, and you're spending at least a year of just spinning your wheels. You could be burning a year of time at least trying to get entitlements, plans together, and architects and all this stuff, only to figure out that your project is not viable, or what goes from a moneymaker to a break even or to a loss. Like in a developer's world, it is not uncommon to lose money. Yes, developers also make money. You hear about your friend who built a deal for $200,000 a unit and they sold it for $300,000 a unit and they made a ton of money, right? And because it happened in a 24-month period of time, 30-month period of time, it was a 70 IRR, right? And they 3x or something. But it's also not unusual for developers to lose money. So my disposition, my personality type is I never want to lose money, ever. So acquisition suits me a little bit better than development. So I feel like those are my thoughts about development.
Yeah, I just don't know if I really, as you mentioned, need to take that risk. I don't really want to invest in any development deals. The only development I would do would be to develop a home or something of that nature, not a multifamily project. I just think that the risk profile for the upside just doesn't really make sense for what I'm looking for, just for the boom bust perspective. And as you mentioned, I'd rather be steady Eddie. I'd rather invest in debt before invest in development would be kind of my take on that one. Just to have that guarantee, basically, or not, close to his guaranteed rate of return, or more stable, predictability, more a risk adjusted rate of return that makes me feel more comfortable at least. So we've been sitting on this article for some time, and this is a Real Deal article pertaining to San Antonio. Of course, we just acquired our first deal in San Antonio, but I want to break down a couple of items. So I'm going to share the screen here briefly. Of course, we are in San Antonio, and this is an article from The Real Deal, which we like to kind of reference their stuff from a content perspective, as you guys know here. But this article is pertaining to occupancy, and if it's a renter's market or a landlord's market from a leasing perspective. So this right here is stating that it's at about an 86.2%, which fall below the 90% threshold that makes a balanced market. So pretty well below that, making it a renter's market right now. We're here. We're looking to acquire more deals here. Of course, there's a lot of supply coming here, but what's your kind of takeaway on this, and how does it make you feel about Houston, I guess, and Dallas as we look at Texas as a whole?
San Antonio is generally a lower occupancy market than, let's say, Dallas, which is tighter, Austin, which is tighter. Houston maybe is around the same or a little bit tighter. And right now there's more oversupply happening in San Antonio than there is in Houston. So there's actually more supply as a percentage of existing stock in San Antonio than there is in Dallas. So the only market in Texas that beats San Antonio of the majors is Austin, which is why, like you mentioned before, has such negative rent growth right now. But okay, Austin's getting 7% negative rent growth right now, but they also got plus 20% maybe multiple years in a row in the run. So we were sitting in Houston, jealous of Austin because Houston was only going up like 13, 15% per year. And Austin was 20, 25, I don't know. And so, yeah, now they go down a little bit. Things kind of all work themselves out. It's not like, oh, boohoo, Austin's the worst market to invest in, right? If you were invested, you were getting it really good on the way up. But San Antonio, I think, is kind of traditionally known as more of a steady Eddie market with not as much rent growth over time, and which having lower occupancy contributes to that, because what causes rents to go up? It's when there's more demand than there is supply. But occupancy is an indication of supply and demand as well. And when there's a lot of vacancy, then that's an indication that there's more supply than there is demand, and it's harder to push rents in that sort of environment. So what I think is really important from our personal standpoint is that we not necessarily block out the noise, but we don't get caught up in this and think, oh, well, if the market occupancy rate is 86%, then we should be content at 86%. That's kind of the traditional thinking, and I think that's incorrect. And the way to actually approach this is to have the understanding that with a well-run property, you should be able to be at 95% occupancy, which is generally considered a sweet spot, irrespective of where the occupancy of the market is. And obviously, what's the variable to give in that scenario? It's rents. You effectively need to be able to price your rents to allow the property to effectively lease to 95% occupancy. So what does that mean? It means maybe you have to lower rents to attract more traffic so that you can be 95% occupancy while the rest of your competition is in the 80s. It's certainly possible. It just means you might have to be at lower rents, but the trade-off is worth it because you'd rather be 95% full at slightly lower rents than have slightly higher rents but then sit at 86 and you've got all these vacants, right? You'd rather collect something than nothing. So I think that's an important concept to understand in these sort of higher vacancy markets.
Yeah, I think it can be generally temporary, and Texas, of course, has got a massive influx of people coming in right now, still moving there. There is other migration to the state from south of the border, where a lot of people are going to stay, certainly in the Texas area, most definitely. So we've kind of seen that in kind of some of our properties. Is that factor? Generally, we are very optimistic, of course, but this is just a short-term hiccup due to the supply and things like that going on online. And I think a lot of these properties too, it's obviously a not desirable headline, but of course, well-located deals and deals with a lot of supply not coming nearby will, of course, help mitigate some of these occupancy issues from a market level perspective. That's why when we go to Houston, we're not buying in the downtown areas like the Galleria or, downtown Houston, places like that where there's always new supply, you're always competing, there's always concessions, more transient people coming in, coming out. We like slightly more of the outskirts of perhaps the downtown areas, more suburban garden style assets.
Yeah, 100%.
Cool. On to another article from The Real Deal, posted not too long ago. There was a property that got foreclosed on in the Duncanville submarket, which is south of Dallas, or South Dallas, I should say. And there's some interesting kind of factors to this one here. First thing that jumped off the screen, I think, for you and me was the price per unit. So let me just go to my notes real quick on this article. The complex was built in 1985 and offered 1 and 2 bedroom units. Commercial foreclosures in the state have surged 126% in March compared to the previous year at 31% from a month prior. So it purchased originally for $284 a unit, and then the foreclosed winning bidding price was 193K a unit.
No, hang on. It wasn't purchased for 34.7 million. It was the debt on it was a Fannie Mae loan for 34.7 million. So the debt basis was 284.4 thousand per unit for a 1985 property. Someone has to have this wrong because this is not possible. Like it says they're townhomes, so maybe these units are 5,000 square feet each.
Is it a build to rent community?
It almost doesn't matter because
Because
that's
I was crunching this out here, and I guess you're, maybe calling cap, as they say, calling BS to the article, but in the article it states about, 284 unit, and then foreclosure winning price was about 193.
sure. So that's the next. So first piece of this is that's an insane basis, right? So who knows what the buyer paid for that? Obviously higher than the debt basis, but that's a crazy high debt basis. So must be really high rents or something. Just for context, we bought a 1980s vintage asset, similar unit count, not big units, so not townhomes so it's not quite comparable. But we
Ones
paid
and twos.
120. Yeah, we paid 120,000 per unit, which is much more in line with 80s vintage workforce housing. And yeah, so for their debt basis to be in the high 280s is or in the 280s is crazy. And then the other really crazy part about this is the fact that there was no bid for the paper at par. So the lender bought back the note at 193,000 per unit, like you said, which means the lender took a what, like a $7-8 million loss on their loan. So they made a loan for, call it 35 million, and then they bought back the debt for 26 million or whatever you skim by the number. So a couple of things that are yeah, it's even worse actually. It's like an $11 million loss actually. So the thing that's interesting about that most of the time in life you never have to think about this or worry about this at all, but in a situation where the lender takes a loss like this in the foreclosure, there has to be an offsetting accounting entry for that loss. Someone's loss has to be someone else's gain. So whose gain is it? Right? Well, it's the borrower's gain. So the lender had to take a loss of 11 million. So that means that is charged. That loss or that corresponding $11 million gain is charged to the partnership. So what does that mean? Because obviously the owner of the property who got foreclosed didn't make $11 million. His or her lender lost $11 million, but that $11 million gain is charged back to the partnership. So now you have phantom taxes. You have a phantom capital gain. You actually have a gain of $11 million they have to pay tax on. So the really, really crazy part about a situation like this is deal gets foreclosed, sponsor goes back to the investors and says, hey, sorry, your 100,000, I lost all of it. Also, here's a K1, you have to pay $20,000 in taxes on the loss and this phantom gain that you got. So it just kind of adds insult to injury and shows just how bad some of these situations can get on these deals that do get foreclosed on. And that's not to mention that a lender can trigger a recourse guarantee to pursue the sponsor for the deficiency. So that $11 million, if the lender feels that the sponsor is in breach of a bad boy covenant, they can trigger a recourse carve out, which most of these loans are non-recourse, but there's all these recourse provisions, all these asterisks that if XYZ happens, the loan can be triggered into recourse, and then they can go and pursue that $11 million deficiency from the sponsor's personal net worth. And that's a scary thing for sponsors, of course. It's all fun and games until you have to sell your private jet.
We don't want that, do we?
No, we certainly do not.
We're going to be very brief this episode. Rob's been having a really fun day today. So dealing with all the fun items in Houston. But before I let you go, just a couple of items. If you could like and subscribe to this channel, it'd be appreciated. I feel like we should probably say that more. So we're going to start saying that more. So please like and subscribe. And if you think someone could find value from the show, might want to invest with us, work with us in the future, go ahead and share this episode with them. That'd be much appreciated. In addition to that, if you are a investor or capital allocator looking to partner with Lone Star Capital in any capacity, learn more about us, please reach out to me via email. The email is Craig, CRAIG, at LSCRE.com. In addition to that, we have our Summit event. We are almost at capacity. I think we've got about 8 tickets left before we're cut off from our reserve cut. Max out from Barclay Rex, from Carnegie Club, the whole nine. So if you want to attend our Summit event, it will be a first-in-class, high-level event with many young professionals there and great people in this space.
Old
that are
professionals
helpful.
too. We don't discriminate.
Yeah, exactly. Incredible professionals there all throughout. So shops, institutional shops, family offices, really everything between LP investors, lenders, vendors, and Lone Star Capital. We'll all be there, and we'd love to meet you and see you there. So if you need anything, you need to know about any of those items I mentioned, please reach out to me. Rob, thank you so much for being on, and I'll see you in not too long. I'll see you actually on Friday.
Oh, we should record in person.
Yeah, we could do that. We could do that. We also probably need to have some guests coming up because we'll be in person, in fact. So we'll brainstorm that. So I think there'll be some fun guests coming up, and of course, a review and probably breakdown of in person, a review and breakdown of the summit event, and then we should probably record maybe the day after. We'll be a little bit tired and groggy likely because we'll be up till 1 a.m. with our investors, and then we'll probably do a Houston episode as well, I assume.
Yeah, plenty to do.
Perfect.
The future is bright.
The future is very bright indeed. Thank you so much, and we'll see you next week.